What if I told you that millions of traders are trying to make money from the S&P 500 every single day, but only a small percentage actually succeed? On the surface, it feels simple. The market trends upward over time. The biggest companies in the world keep growing. The economy expands. So logically, making money from it should be easy. But here's where things start to break. Knowing that the market goes up and actually making money from it are two completely different things. And that gap is where most traders lose, not because they are unlucky, but because they misunderstand how the market really works. The illusion of easy money. One of the main reasons people are attracted to trading the S&P 500 is because it feels safe. It's not a risky startup or a volatile individual stock. It's a broad market index backed by strong, established companies. This creates confidence, a belief that the market will always recover and continue moving upward over time. But this belief can become dangerous when applied to trading. In trading, direction alone is not enough. Timing becomes everything. You can be correct about the long-term trend and still lose money in the short term. For example, the market might be in an overall uptrend, but within that trend, it can pull back, consolidate, or move sideways for extended periods. Traders who enter at the wrong moment or react emotionally to these movements often get stopped out before the real move happens. This is where many beginners get frustrated. They feel like the market is working against them, when in reality, they are simply operating without understanding its rhythm. Why most traders lose money. Most traders don't fail because the S&P 500 is impossible to trade. They fail because their approach lacks structure, patience, and discipline. Many traders fall into the habit of overtrading. They enter positions too frequently, trying to catch every move instead of waiting for clear opportunities. This leads to unnecessary risk and inconsistent results. Others rely too heavily on indicators without understanding the bigger picture. They expect patterns to work every time, not realizing that market conditions constantly change. Emotions make the situation worse. Fear causes traders to exit profitable trades too early, while greed pushes them to hold on to losing positions for too long. Frustration often leads to impulsive decisions that break their strategy entirely. Over time, these behaviors create a cycle of losses. Even if a trader has some success, inconsistency eventually cancels it out. The role of institutions. Another key factor is understanding who is actually driving the market. The S&P 500 is not dominated by retail traders. It is heavily influenced by large institutions, hedge funds, and algorithmic trading systems. These participants operate with advanced tools, deeper data, and significantly more capital. They analyze liquidity, positioning, and macroeconomic trends in ways that go far beyond simple chart analysis. Because of this, price movements are structured. The market often moves toward areas where liquidity exists, where large orders can be filled, and where positions can be adjusted. This explains why price sometimes behaves unexpectedly. A level may break briefly, triggering stop losses, only for the market to reverse direction. To a beginner, this feels random, but in reality, it is part of how the market functions. Understanding this changes how you view price action. It stops being confusing and starts to feel more logical. The difference between trading and investing. A major mistake many people make is treating trading like investing. While both involve the same market, the approach and mindset are completely different. Investors focus on long-term growth. They are not concerned with daily price movements. They hold positions for years, allowing the overall trend to work in their favor. Traders, on the other hand, operate in short time frames. They rely on timing, precision, and discipline to capture smaller moves. This requires a completely different skill set. Because of this, someone who is successful as an investor may struggle when they try to trade. The patience required for investing is different from the precision required for trading. Understanding this difference is critical. It helps you avoid applying the wrong strategy to the wrong approach. The reality of consistent profitability. So do traders really make money from the S&P 500? The answer is yes, but it is not as simple as it seems. Profitable traders are not perfect. They do not win every trade, and they do not predict the market with complete accuracy. Instead, they focus on consistency over time. They manage risk carefully, ensuring that losses are controlled while allowing profitable trades to grow. They understand that losing trades are part of the process and do not let them affect their overall strategy. They also avoid forcing trades. They wait for setups that align with their plan, even if that means staying out of the market for extended periods. Over time, this approach creates stability, not because they never lose, but because their wins outweigh their losses. What actually works in S&P 500 trading? Traders who succeed develop a deeper understanding of how the market behaves. They focus on both technical and fundamental factors, combining them to build a clearer picture of market conditions. They pay attention to interest rates, inflation data, and economic events that influence market direction. They understand that these factors shape the broader trend, even if short-term movements appear random. They also develop patience. Instead of reacting to every movement, they wait for high-quality setups that match their strategy. This reduces unnecessary risk and improves consistency. Most importantly, they prioritize risk management. They protect their capital, knowing that staying in the game is more important than making quick profits. The psychological edge. One of the biggest differences between profitable and unprofitable traders is psychology. Trading is not just about strategy. It is about how you handle pressure, uncertainty, and emotion. Every trade involves risk, and outcomes are never guaranteed. Successful traders learn to stay calm during losses, stick to their plan, and avoid emotional decision-making. They understand that consistency comes from discipline, not from chasing quick wins. This mental edge is what allows them to perform consistently over time. So do traders really make money from the S&P 500? Yes, but only those who understand how the market truly works and approach it with patience, discipline, and a structured strategy. It's not easy and it's not fast, but it is possible. Once you move beyond the myths and start focusing on consistency, risk management, and long-term improvement, everything begins to change. The market starts to make more sense, and your decisions become more controlled. If this helped you see S&P 500 trading differently, make sure to like this video and subscribe for more content like this. Because in trading, the difference between losing and winning is not luck. It's understanding and what you do with it.